Hey, do you like paying taxes? Have you ever thought about a tax-free retirement? Those are silly questions, are they? Who really likes to pay taxes, right? Well, hello, my name is Kurt Jackson. Welcome to FinancialSenseTV.com. Today's video hopes to inform you about the opportunity that you're going to be hearing more and more about this year that allows higher income earners that have not been able to have or to contribute to a tax-free Roth IRA convert their current IRAs to a Roth IRA. All right, well, let me back up just a little here and explain in a little more detail about this. First of all, let's talk about an IRA. That's an individual retirement account, and as the title explains, it's an account that's designed for retirement. Simply, it allows you to deduct the amount within certain IRS rules, deduct that amount that you invest into an IRA from your income to help you lower taxes today, now, okay? For instance, a married couple that makes, let's say, $90,000 a year, they'd be in the 25% marginal tax bracket. So if they invested, let's say, $6,000 into a qualified IRA, they would have cut their tax bill by 25% of that $6,000 or $1,500. So they got a $6,000 deduction, and in the 25% marginal tax bracket, that cuts their tax bill by $1,500. The other aspect of the IRA is that as the money grows in the account, it grows without tax, okay? We refer to an IRA being tax deferred, and that's because you don't pay tax on this money until you're ready to pull it out in retirement. So the IRA is a tax deferred vehicle. All right, so now that $6,000 grows, tax deferred over time, let's say for 30 years, at an assumed 6% return. It would be worth $36,135 at that time. Now let's say the $36,135 gave you a $2,168 annual income for life, okay? And at that time you were in the 20% marginal tax bracket. So you would pay $433.62 in taxes every year of your life. So your net income would be $1,734.38. Well, let's say you lived 20 more years. You would have had to pay back a total of $8,672.40 in taxes. So in this scenario, you would have saved $1,500 in taxes today, and you deferred your taxes on the investment to be paid in the 20 years of retirement that we're assuming, meaning you would have paid $8,672.40 in taxes. And remember that you were in a lower tax bracket in retirement than our first initial assumption of being the lower tax bracket of 20% in retirement, which was lower than the 25% marginal tax bracket we assumed you were paying now. All right, well, with the Roth IRA, it's different. So you pay the taxes up front today, and the money is allowed to grow tax-free, and you can take the money out tax-free in retirement. So in our scenario above, instead of investing the $6,000, you'd have had to pay $1,500 in taxes, thus leaving you with just $4,500 to invest. If we invested that $4,500 at the same 6%, assumed 6% return for 30 years, it would grow to $27,101. Well, let's say that $27,101 gave you $1,626.06 per year tax-free for life. Now, I realize that this is $108.32 per month less than the IRA gave us in this example. But there's a couple other things you need to be aware of. First and foremost, your tax-free income is going to be lower if tax rates are lower in the future. All right. Secondly, and this is a more complex concept I'm going to go into a little bit more deeply here, is it can impact your Social Security income taxability. See, just about any income, well, except for the income from a Roth IRA, so just about any income in retirement can make your Social Security income taxable. All right. If your retirement income is $25,000 or more for a single, or $32,000 or more for a married filing jointly, then 50% of your Social Security income is taxable. And if your income is $34,000 or more as a single, or $44,000 or more as married filing jointly, then 85% of your Social Security income is taxable. All right, so let's say your Social Security income was $1,800 per month and you were still in that 20% tax bracket. You would pay an additional $180 per month in taxes if you had enough retirement to be in the 50% level of Social Security taxation, and $306 per month in extra taxes if you had enough retirement income to be in the 85% level. See, folks, this is a little known, avoidable additional cost in retirement that so many overlook in their planning. See, now we initially looked at a comparison if your future tax rate was lower than now. But what if that tax rate was the same 25% in retirement as it is now? Well, then the incomes are the same before and after tax. But that Roth income doesn't count against the taxation on Social Security income. And if the tax rates are higher in retirement, then the income is more with the Roth than it would be with the traditional IRA. Now, do you think tax rates will be higher, lower, or the same in the future? See, this is a huge factor in deciding if the Roth conversion makes sense for you, the way you feel about future tax rates. All right, well, I wanted to give you a basis of knowledge about IRAs and Roth IRAs to work from. Most of the financial folks out there are going to likely be telling you that with all the benefits of tax-free income instead of tax-deferred income, you should convert your IRAs to Roth IRAs. Folks, this video is designed to help you decide if you should do it because it's in your best interest, not do it because it's in their best interest. All right, well, now you have a basis in understanding the IRAs and Roth IRAs. Here's what's going on. Beginning in 2010, this year, the government's allowing everybody, but more importantly, higher income individuals, a way to convert their tax-deferred IRAs into tax-free Roth IRAs. See, previously, higher income individuals and couples, basically anyone earning more than 100 grand, weren't able to convert to a Roth IRA. They're not able to have a Roth IRA. Well, now that income limit has been removed. See, if you convert your IRA to a Roth IRA, you're going to have to pay taxes on the amount you convert. You do have the option to spread the taxes over 2 years by paying half in 2011 and half in 2012. But I want you to keep this little nugget in mind. You know, the tax cuts from the Bush administration, guess when they're set to expire? Yeah, that's right, in 2010. I wonder why the government would let you spread that tax over 2 years after those tax cuts expire. See, if the tax cuts are expiring, do you think the current administration with the current situation will extend those cuts or let them reset to a higher level? So you pay you pay tax on the conversion, all right? Now this isn't an extra tax, right? Because you're going to have to pay tax on that IRA money at some point in time. But if you decide to convert now, you're just choosing to pay your taxes now and not in the future. You can pay those taxes with funds from other accounts that are not qualified, like CDs, mutual funds, stocks, bonds, money markets. Or you can take that money out of your qualified plans, your IRA, your 401ks, your 403bs. Be aware of this, okay? If you do pay the tax out of your qualified plans, the IRAs, the 401ks, then you're going to pay taxes on that amount too, all right? And you're going to pay a 10% penalty on that additional money if you do this conversion before the age of 59 and a half. Now, do you think that's a pretty steep cost to convert? I do. All right, well, we're running short on the time for this video, so I'm going to go into more depth on this concept of paying taxes on this with money from a qualified plan versus a non-qualified plan. So stay with us. If you'll look down right below this video, there'll be a link for the second video in this series. So go ahead and do that now.